Okay, this video is just going to give a quick summary of some recent taxation reforms, some of which we've alluded to in other videos. So in terms of the 16-17 budget, so last year's budget, it's important that you use, in case you get asked for policies from a particular budget, that you're using the correct budget. So in last year's budget, the 32.5% tax bracket increased from 80 to 87,000, which was designed to encourage participation, particularly amongst middle and high income earners, which was talked about in the last video. The 10-year enterprise tax plan, which was continued this year, so it helped to reduce the corporate tax rate to 27.5% for businesses with turnover of less than 10 million, with the aim of lowering it to 25% for all companies by 2026-27, and an 8% tax cut for unincorporated businesses. They're two key policies to talk about. Other forms of tax reform, this one's more about fiscal consolidation. So they've placed a 40% penalty rate of tax on any multinational companies that try and shift their profits overseas. So any company found guilty of trying to shift their profits overseas will now be penalised with a 40% penalty rate to try and make sure that companies are paying the right amount of tax in Australia. Other policies from last year, changes to superannuation tax concessions. So what that means is that high income earners, basically with super, if you put money into your super account, rather than being paid at your marginal tax rate, which can be like 45%, you can put more money into your super and only pay 15%. And therefore, it's an encouragement for people to put more money into super. What they've done is they've increased the rate of tax to 30% for any contributions for those earning more than $250,000. So it used to be that you started paying 30% for contributions above on earnings above $250,000, $250,000. Now it's $300,000. So that's another big thing that they're doing to try and get money back. They're also reducing the amount of money that people can put into their super to try and reduce the amount of tax concessions, so the people have to pay the right amount of tax. So this one we talked about in the last video, so I don't need to talk about again. And they're putting caps on the total amount that people can put into their super. That one's for some reason I've repeated as well. In the 17-18 budget, they've extended the small business immediate tax deduction, the immediate depreciation allowances. So if you buy anything worth up to $20,000, you can still immediately depreciate that for businesses with a turnover of less than $10 million. The idea being that you'll invest in better assets and machinery, which should help to boost productive capacity and productivity in the long term. All right, now we're going to talk about some of these reforms and how they impact the goals. So tax reforms have a big influence. The idea is to stimulate personal effort. They're trying to boost productivity, they're trying to create effort, and also promote entrepreneurialism and investment. Some changes are related to bracket creep, but the idea of most of these policies is to try and boost these sort of things. Boosting productivity, boosting willingness and ability to supply, which should all lead on to increased material living standards. It can also promote increased investment in high-tech equipment, so if we're looking at changes in company tax rates or depreciation allowances, which will also boost the quality of our capital resources. So, first of all, tax reforms and low inflation. Again, there's a range of things you can talk about in relation to cost-push inflation. So one thing is that it allows workers increased disposable incomes, so they may be less likely to fight for a higher wage, so they might be more content with their income, and therefore they may be less likely to fight for a higher wage. They provide an incentive to gain a further education, which can lead to better skills and better labour productivity, which helps to reduce inflation. They allow firms to have higher after-tax profits, which then allows them to, basically what that means is their production costs have essentially gone down, so they can sell at a lower price and still achieve the same profits. So one reason why lower company tax rates reduce inflation is that firms can keep their prices lower and still make the same profits as they were before in terms of after-tax profits. So they're more likely to charge lower prices. They're also more likely to invest in new technology, which boosts their technical efficiency. So make sure you're aware of both reasons why lower company tax rates help to reduce inflation for businesses. Other changes might be changes in tariffs, which promote specialisation, and then you can link that to promoting resources to areas of comparative advantage, which boosts allocative efficiency and reduces import prices. We'll talk about the other goals in the next video.